Welcome, everybody, to LPL Research Market Signals podcast. My name is Mark Zabicki, Chief Investment Officer at LPL Financial. Joining me today is Quincy Crosby, Chief Global Strategist of LPL Financial. Quincy, how are you today?
Doing well. Thank you. Thanks very much.
Good. And I'm excited to have you because we are going to get into a conversation about China. We're going to get a conversation about the dollar, what central bankers need to do about the dollar, about market interest rates, et cetera, et cetera. So looking forward to your comments on that. So a lot of big moving parts going on simultaneously. On top of that, we've got earnings to talk about a little bit in terms of your expectations for some key earnings reports coming up and what that may mean for sniffing out the next perhaps direction in the equity and capital markets in general. Is that fair?
That is super fair. Yeah.
Okay. Important disclosures for everyone. And just to let you know, if I haven't already said it, we are recording this on Tuesday, October 25th. So recording this on Tuesday, October 25th. Let me just start by opening up with what's happened over the last week. We are actually getting a little bit of a technical reprieve in U.S. equity markets, not so much in other areas of the globe in terms of equity market performance, but we're seeing some semblance of a technical bounce in equity markets in the U.S. Some equity sectors that have performed rather well. Energy is notably higher. Technology is notably higher. Actually, across the board, strengths in many areas other than real estate and utilities. Quincy, as you think about the last week in equity markets, any key takeaways for the audience as to how things may be shaping up?
Well, absolutely. I mean, the market was music to the market's ears on Friday, the Wall Street Journal story regarding the November 2nd meeting of the Fed, which is just around the corner, and that they will be discussing not the November rate hike, which the market expects to be 75 basis points, but what they're going to do in December and whether they're going to de-escalate the aggressive campaign, perhaps soften the rhetoric, and then perhaps for December go to 50 basis points and then perhaps another 50, but 25. In other words, the terminal rate perhaps ending just under 5% or 5%. This has been music to the market's ears, and the market just rejoiced on Friday, and we know it was technical. You mentioned that because it wasn't led by a stock doing very well, a company doing very well, because it was across the board the same amount of the market going higher. It was almost like the algorithms coming in and just pushing everything up with the same amount. That is technical, and it was predicated on that story. So the question now is, does that story portend that the Fed, and is the market sniffing out, that the Fed may be beginning to, after this November 2nd meeting, beginning to transition, and that's the word we've been using at LPL Research, not pivot, but transition to a softer pace, a less hawkish pace, and that's the best way to package it. Certainly 50 basis points is not dovish, it's just less hawkish.
Yeah, and we've talked a lot about that, obviously, in the Strategic and Tactical Asset Allocation Committee at LPL Research. Yes. I mean, we talk about the Federal Reserve, inflation, and interest rates every session on a Monday, it seems, and so it's actually good to see the market begin to look ahead over the next 6 months or 12 months or so, and try to figure out what are we actually going to look like when the Federal Reserve either slows down or stops. So those are great points. Not as much fun in bond markets, and we're going to touch on this, Quincy, in terms of what's going on with Treasury yields and what central bankers may need to do there. But the shining point in the last week of the bond market really is high yield, as we see some risky assets get more attention over the last week or so. High yield has been one of those, not grand attention because it's just flat, but certainly better than other areas of the bond market that are still under pressure with the illiquidity in the Treasury market and some volatile action across the bond complex. On the commodity side, the weak area, clearly, I think, if we look at commodities broadly, we've peaked earlier in this year. We may be trending lower. Obviously, the direction of the economy is problematic in that. What may or may not be happening in China is probably problematic for this area of the market as well. So we'll get into a little bit more about China as we move on with this Market Signals podcast. So last week, Quincy, I mean, you touched a little bit on this in terms of Federal Reserve commentary, but we are seeing some cooling in the economy, and I'm going to guess it's probably good news. Bad news is good news in this case. Is that fair?
Yeah, absolutely. Yeah, absolutely. The Beige Book came out, and it and by the way, it sounds so boring, Beige Book, because it used to be beige, but it happens to be fairly up to date, considering, that most data releases are looking back a whole month. And it's anecdotal, but the point is, across the US, it looks as if the economy is slowing, it's cooling, but it is not cratering. And that's good news.
Yeah, and we mentioned a technical bounce for equities. You touched on, what the market may be kind of sniffing out in terms of future Fed policy. We still have a illiquidity problem in the Treasury market, and we'll touch on that a little bit later as to what central bankers or other policymakers do on that. We'll also get into, the dollar strength as well on this call. Which is contributing, I should say, to some market unease. Obviously, the China Communist Party Congress last week was all in the news and what went on there. Again, we'll touch on that, and then also corporate earnings. So quite a bit to digest last week in terms of market activity. If we look ahead for this week, we have started off the week in U.S. economics around the S&P Global PMI composite services and manufacturing, all numbers which have come in less than expected yesterday, which again is, Quincy, part of that cooling aspect of the economy, which feeds into that, kind of semi-bad news, perhaps is good news in terms of Federal Reserve expectations. New home sales coming up, initial claims as always on a Thursday, PCE deflator, and then Michigan sentiment, to close the week out. Turning to you, Quincy, anything here that you have your eye on in terms of a key barometer for folks to watch?
Absolutely. It is the PCE, the Personal Consumption Expenditures Index. This is what the Fed looks at. Yes, they watch the Consumer Price Index, but this is their favorite one. Typically, the numbers are cooler than the counterpart in the Consumer Price Index. But remember, if this surprises, how shall I say, to the upside, and is hotter than the Fed expected, that's going to be difficult for the market and difficult for the Fed, because remember, the market is sniffing out that perhaps the Fed gets less hawkish. Similarly, the University of Michigan, what we don't want to see is the consumers' view of inflation climbing higher. You want to see that lower. If that climbs higher, that is something that the Fed will have to address somehow, and the way they do it is being more hawkish. You may remember that what pushed the Fed to 75 basis points from 50 basis points during a blackout period, by the way, happened to be the PCE, followed by the University of Michigan survey and the consumer view of inflation. The Fed sent out a message right away during the blackout period, again, to the Wall Street Journal, and then it wound up all over the business news that, by the way, they would probably be moving from 50 basis points, which is what we all thought, to 75 basis points. So let's hope that these numbers do not underpin a more hawkish Fed, but rather help the Fed begin to see that inflation is in fact easing. In fact, by the way, you mentioned the S&P Global PMI report. One of the things in that manufacturing report indicated that the prices, the input prices towards manufacturing were coming down, not climbing higher, but were coming down. This is the kind of thing we're looking for. This is the kind of thing that the Fed is looking for. So in many ways, that was actually good news.
Yeah, no, you're right, Quincy. As a matter of fact, we've spent the last couple editions of this Market Signals podcast talking about some input prices that are indeed coming down, and how the CPI and PCE would lag that a little bit. So
Yes.
that really has driven our conversation around inflation and the expectation that it is going to begin to tail off here, not only through 2022, but also into 2023. So that's a really good point. If we look also at PMI activity across the globe in the Eurozone, Germany, and the UK, again, numbers that are less than expected. That cooling scenario in terms of what central bankers would like to see. So PMIs are probably the biggest numbers across, non-U.S., economic calendars. This week we are getting the CPI numbers in Germany and France later in the week. Anything catching your eye here, Quincy, in terms of things to pay attention to?
Well, yeah, I mean, the European Central Bank is going to meet, and they've got inflation climbing higher, but they also have export demand weakening for Germany, for example, the largest economy in the Eurozone, and also the one that is faced with an energy crisis this winter. So it's going to be interesting to see whether or not the European Central Bank, and this has to do with the dollars, I know we're going to talk about that later, but whether or not they will stick to a higher interest rate at this point, because if they don't, the US dollar is higher. It's always about the interest rate differential in this market where we are right now. So we hope that they go to 75 basis points instead of 50 at this point, because otherwise our dollar will climb higher, given that the market thinks we're going to 75.
Yeah, that's a good point. And the ECB is expected to go to up 75 basis points on Thursday. Looking at the key issues this week, and we're going to just touch on these real briefly and get into each one or nearly each one in the next several slides. But earnings season continues. Let's actually touch a little bit deeper on earnings season on this slide, Quincy. You've got, I know on the top of your mind, some key reports coming up in the near term here that you think are going to be important for perhaps setting direction in terms of expectations of Federal Reserve policy, just setting direction in terms of what the market may be sniffing out in terms of that potential of Federal Reserve policy change, et cetera. So what should we be paying attention to in terms of our earnings calendar?
Well, this week it is tech. It's big tech. Together, they represent about 20% in weighted in the weight with the S&P 500. Apple, Microsoft, Google, Alphabet, Amazon. These are extremely important. And what we want to see is whether or not, if they surprise to the upside, because again, what we're looking for is all the bad news in. Bad news for big tech is, higher interest rates, right? It is a stronger dollar. For Google, for example, it's advertising. So for Apple, it is about whether or not they can maintain their margins and whether or not their sales are going to surprise to the upside. Because remember, there was a scare that the lower priced iPhone was not selling, and we want to see if that changes. Does that pick up? All of this is going to be important. Obviously, Microsoft with cloud is going to be important, and even Google with cloud is going to be important. All of these will be crucial, and we will see if it's positive surprises, if the market holds. We had an issue with Netflix. Before the Fed was raising rates, and whenever there were issues with technology, the market would wait for Netflix, after the bell, always before the other big tech names. And if Netflix did well, if there was a positive surprise, it would tend to help underpin the market and underpin big tech until their turn came in the earnings season. Not this time. This time around, it didn't help. Netflix did well, but it didn't help the rest of the market. We think that big tech, all of these names, could help underpin the market, because what it would suggest is that the market is sniffing out the tail end of the aggressive trajectory of the Federal Reserve. Therefore, that rates start to come down. The enemy for big tech, by the way, as you know, is higher interest rates.
Yeah, well said. And as we look through these other bullet pointed items, we'll probably leave the UK Prime Minister for another session of market signals. That's probably a longer conversation. So we'll leave that for the next go round. We're going to manufacturing services composite activity. We did look at that earlier in the call, and things are in fact slowing. You touched on something interesting to me, Quincy, yesterday in the Strategic and Tactical Asset Allocation Committee meeting about election expectations and some of the activity that you're seeing across industries and sectors, and how the market may be sniffing out some election results, perhaps. I mean, any comment around that? I mean, we basically kind of want to retalk about what you discussed yesterday in front of the committee?
Well, yeah, I mean, that was yesterday. This is today, because it's so close in so many in so many of the tight, very tight elections. But that is that the market seems to be sniffing out a Republican sweep. This is important. It's not going to be the be all and end all, but it's important because what it suggests is that some of the programs from the Democrats will not get through. Some that the market just doesn't want to see. But also, on a positive note, it will certainly help underpin even more the energy sector, and it will help underpin, I think, the industrial sector, especially with defense. It doesn't mean that the Democrats are going to say, well, we're not going to spend on defense. But the point is, the Republicans will probably go more. Now, I do want to point something out. If it is gridlock, in other words, the Democrats keep the Senate, the Republicans keep or have the House, gridlock is fine for the market. The market actually doesn't mind gridlock at all. But there is one thing I do want to point out in terms of defense, and that is Republicans are now suggesting that for Ukraine, aid may be pulling back, not as generous as under the Biden administration. What that could possibly do, at least initially, is hit the defense names. Many of the analysts are saying that if that were to happen, it would still be a buying opportunity because budgets are up all over the world, not just because of Russia and NATO, but also because of China and China's aggressive spending on with their military budget.
Yeah, I mean, and you raise an interesting point just on energy and kind of what the machinations are between the Democrats and the Republicans on that space. I mean, we took a look. Energy has been up about 7% over the last week, so that speaks to perhaps what the market is telling you in terms of election expectations. In an oil price environment it's bounced a little bit, but it hasn't been dramatic. So it would be unusual for energy to pop up, although earnings have indeed been coming in fairly well. I want to turn a little bit to China, Quincy. I know again we've talked about this and what may or may not happen as a result of the Congress last week. So Xi certainly kind of swung his sword around and got another term, and it was basically expected. I think I'm going to let you tell us whether that was expected or not completely. But as you look at the situation, did last week in China meet your expectations? And what do you think this means for the market, or how should market participants digest what happened last week?
Well, it's interesting because there was, she sort of disappeared. It was like, where is she? Where is she? Just before the meeting. But it began to be clear that he was going to have the third term. There would not be, remember why? He's the one who got rid of term limits, precisely because he wanted a third term. And it looked as if he was going to consolidate his power with his people moving into senior spots. Now, they did, and he is, how do we say, but he has made it very clear he is the core of the Politburo. He is the core of activity in China. Everyone is calling it, a Mao Zedong reincarnation. He even has something along the lines of his speeches and his writings, that comes straight out of Mao. But nonetheless, if the market had believed that the economy was going to be the *1 priority, and let's remember, China's economy is lagging. They have a debt-laden real estate market, but the zero COVID policy, stringent, locking down entire communities, 22 million people at a time, has added to it. I mean, no activity whatsoever. I mean, and China is also a major supplier to the globe. So if the market had believed that that was going to be lifted, you would see commodity prices, I think, coming out of that meeting, climbing higher. But they didn't. They did not, because he said, look, we want to modernize the economy. Certainly we do, but we're going to make sure that, in essence, we're not going to create billionaires. This is a big focus for him, that it's redistributed, that the middle class can do well. But we're not going to have, he doesn't want the cult, by the way, the cult around the billionaires. You noticed Jack Ma, where is he? You don't see him anymore. Alibaba, he went away. Remember, he went away because there was a cult following. She does not want that. So the other part is about, do they ease the restrictions? And then there was a rumor that they were going to ease the restrictions regarding the quarantine for visitors. It's a very long quarantine, that they would cut the amount of time you have to be in quarantine. What that did was it led to the market extrapolating from there and saying, well, this must mean that they're going to ease the restrictions on testing and lockdowns. Not so fast. And, you'll hear folks say now, well, maybe he has to wait. Maybe he's going to, he sees this as his personal ideology in terms of getting rid of COVID, not just helping people live with COVID, but getting rid of COVID. Now, either he changes that, there'll be a meeting in December, we'll see if they ease the restrictions, but so far, no one is expecting it right away at all. So that's one thing, and that then keeps the economy, sort of weak. In addition to the debt-laden real estate market, whoa, this is a big one. It is a big one because that market is about a quarter, some people even say a half of their GDP. The GDP in China is about $18 trillion, or maybe now 19 trillion. So even if it's a quarter of that, that's a big chunk. The question really is, does the government bail out the developers who are, just debt laden, who have defaulted? And by the way, where there's US dollar denominated debt that's out there, by the way, with foreign investors. Most likely what we're going to see is something that has caused Xi heartache and trouble, potential trouble. And that is that many of the people who bought condos and houses, however you want to call it, in China do so before they are actually completed. Well, guess what? And they have to pay the mortgage, by the way. These properties have not been completed, and folks are going nuts on the internet, on the internet, well, like, where's our property? Why should we pay? Maybe we'll stop paying. And there's a movement to stop paying. She made it very clear that they are going to fix this, and maybe not so much in the plenum, but he has talked about it. They are going to fix it, and they are going to force the property owners, perhaps via a fund, a public fund, and lowering rates and giving them access. They can't really get private funding anymore, but through a public fund where they go in and fix these condos, just get them finished. This is going to be a priority. And why is it going to be a priority? Because President Xi and also the Chinese authorities do not want any trouble. They don't want demonstrations. They don't want this to lead to something that you're seeing, for example, in Iran. That is something that is verboten in China ever since Tiananmen Square. And that said, the other issue for China is, for investors, is regulation. The expectations are that the regulatory framework is going to really be very strict. And that's why you saw the sell-off. The sell-off was dramatic, particularly in the internet stocks. That's going to shut down. You see the banners going up. Do you see the signs that are being written in the bathrooms in China? You know why the bathrooms? Because there is an assumption that at least in the public bathrooms, there is no surveillance. China is ruled by surveillance cameras everywhere. And so this is it. The yuan, offshore yuan, is plunging as we speak. Investors want out until there's clarity, and we have to wait to see. We have to see if things change for the better.
Yeah, Quincy, I mean, that's a great point. I mean, you just kind of broadly, almost in summary, that, if you're an asset allocator, Xi Jinping's tighter grip on China has not been a good thing for China's equity market. It has not been a good thing for emerging markets broadly. And some of the issues that you mentioned, fundamentally, debt problems, tighter regulation, things of that nature, is certainly no longer moving in the direction of a westernized economy, have all been problematic for asset allocators in emerging markets, in China in particular. And we, as a committee, believe that will continue to be a problem. And some of the issues that you raised are certainly central to some of that. I want to also turn attention here, and let's kind of cover this, if you don't mind, in really kind of two parts. We'll look at the U.S. Treasury yield. We also look at the dollar. Both have kind of gone parabolic. Again, the U.S. Treasury yield and the dollar. We talked yesterday in the Asset Allocation Committee how this is likely going to have to be addressed by policymakers, both monetary policymakers and fiscal policymakers as well. So Quincy, talk to us about some of the illiquidity in the Treasury market, some of the parabolic nature of the movement in the dollar, and what we think central bankers are perhaps going to do about it, and what that may mean for future interest rates.
Well, that's a lot. So what we've seen is, if you look at it, and here's the interesting, we have a virtually synchronized global central bank rate hike campaign, except for the second and third largest economies in the world, China and Japan, for different reasons. Japan is seeing its yen almost collapse. They have done some interventions, and let me just, the reason, if you're following it, is they follow a strategy called yield curve control. This requires the Central Bank of Japan to buy bonds to push down their 10-year yield. They believe that by pushing down their 10-year yield, and it's in a very, very tight range, that they can help induce inflation. Remember, Japan has gone through a terrible deflationary period ever since the economy collapsed, the markets collapsed decades ago now. However, inflation has been rising. It's above 2%, which is where they wanted it, but still the head of the Bank of Japan insists on the yield curve control. You can't have a currency rise on its own if you have your central bank pushing down your 10-year yield. It just doesn't work. So you've had the authorities, the Ministry of Finance, go in and try to do an intervention. They have not worked. The Japanese yen continues to come down. And here's the problem. We can't get into it, but there's something called the carry trade. I go in and borrow where the cheapest currency is, Japanese yen, and then I go out around the rest of the world and I make a lot of money. I'm a speculator. I make a ton of money that way. And then I go back and pay it back in Japanese yen, which is cheap. It has been a buffet for speculators, which is something they do not want. So in any event, I think the reason they had this intervention, which by the way, they did not announce officially afterwards, but we know that it happened. And also the Bank of Japan at the same time is buying bonds for their yield curve control. So that's a whole other issue for scholars to discuss. But in any case, the yen is back down. They need to have Caruto say, at least rhetorically, well, we will discuss, the future of yield curve control now that we have inflation above 2%. Even that would help, never mind an adjustment somewhere with the yield curve control, but he's pretty adamant that that is not going to happen. So in any event, why did they choose just recently to do it? How about that the dollar weakened? Thank you, Wall Street Journal article. Because if you have a sense that the Fed is going to be becoming less hawkish, not more dovish, but less hawkish, that we're transitioning to that, your currency is going to weaken. So I think they took advantage of that because you saw on Friday that yields inched down a bit, not dramatically, but inched down, but so did the US dollar. Actually, we're back with a stronger dollar right now. But in any case, so you have that. China does what China does. Their currency is weak. You could argue that Japan, is a major exporter. A weaker currency does help them. And same thing with China. The only problem is that demand is down. So it's not as if your weaker currency is going to help dramatically, because on the other side of that equation is weaker demand. But nonetheless, the yuan, especially the offshore yuan, has been battered. Investors want out. They want out. They don't want to be there. And more central banks, again, have to deal with the stronger dollar. Emerging markets is an old story. When do emerging markets emerge? When do they finally have love from investors? Because, when they're good, they're really, really good. When they're bad, boy, are they nasty. So here you have a situation in which commodities are more expensive because of the stronger dollar. Oil is more expensive for those that import oil. You also have dollar-denominated debt. In the dollar strong, it hurts them paying and servicing that debt. It's a vicious cycle. And, you could look at Latin America. They've done well with the stronger dollar, even though it could hurt them, but there's demand for their products. It is a difficult thing. You mentioned China. How about this? On the institutional side, Mark, more and more portfolio managers are creating emerging market portfolios ex-China. If you want China, we'll do a China one, but ex-China, because they don't want the contamination, and not in the bad sense, in the financial sense, of anything going wrong. How about Taiwan? How about we heard what she had to say? It was pretty direct. It was so direct that there was a response from the U.S. And he basically made it sound as if, our calendar on Taiwan has just gotten a little bit closer, right? That's what he said. And he said, basically, they do it the nice way or they do it the more difficult way. That's what he said. And he said, it is about the unification that is necessary, the unification that is in our worldview of things. So that is something that's very difficult. So the point I make that institutionally, folks are saying, look, if that starts to happen, we don't want to be invested in emerging markets. That 35 to 40% is China. Because obviously, if something like that happens, you're just in a terrible situation. So more
Yeah.
and more, that's what we're seeing.
Yeah, there are quite a few moving parts in the world, big moving
Yes.
parts. Ukraine policy is one of them. Taiwan policy is certainly another.
Mhm.
And the rising dollar, you can rest assured that's been a point of conversation as central bankers talk to each other across the world, because they do
They do.
discuss policy, and the workings of the Federal Reserve have made things more difficult from a dollar perspective across the globe, right? So it's complicated. So let me ask you this, Quincy, in terms of the way Janet Yellen thinks of it in the Treasury, the way Jerome Powell thinks of it at the Fed. What do you think the likely action or potential action could come from in terms of any Treasury policy or any Federal Reserve policy that may emerge as a result of the illiquidity in the Treasury market and the rise in the dollar? Are we expecting anything from
Yes.
either group of policymakers?
Yes, certainly, Janet Yellen. Remember how this all happened. Believe it or not, it was because of the great financial crisis. And none other than Paul Volcker was involved with this and what the banks could do and not do. And so I think that there's more liquidity is going to be provided. She's working on it. They know it. And remember, what was it, September of 2019, we had a problem in the repo market that scared the daylights out of the overall market because everything just sort of froze up. The Fed does not want to see this happen again, nor does Janet Yellen. So I think that they are working on it. I think you're going to see much more liquidity coming into the market so that the market can function properly and that there's no fear of liquidity drying up.
Yeah, I mean, good point. And when you see, the 10-year Treasury yield moving by 10, 15, 20 basis points in the day, that's typically not normal. And we expect policymakers to take action. So let me say this, Quincy, I appreciate you joining us today on Market Signals. Always a pleasure having you. Thanks for your insight on China, the dollar, Federal Reserve policy, et cetera. It certainly has been helpful for our listeners here at Market Signals. I want to thank the audience for joining us today, and we'll talk to you next week.